Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial trading advice in any way. Right, I'm here. I'm back on YouTube. It's been a while again, I know. And today we're going to be talking about the United States stock market, and this video is going to be something a little different. We're going to be talking about long-term investing. And we're going to break things down super duper simple. And the reason we're doing this is we've just gone through new all-time highs in the stock market, new all-time highs in any market, stock market included, or cryptocurrency market you might know, or whatever, right? Gold, commodities. It brings in new blood, right? Always brings in new blood. And this is true day after day, week after week, month after month, year after year anyway, as the markets become more accessible, information technology improves. You know, we just bring more and more money, more and more liquidity into these markets. But new all-time highs tend to ignite excitement, tend to ignite interest, because maybe someone's heard that their neighbour's doing very well in the market, or maybe it's a friend or a family member, and they own this stock, they own that stock, and it's going to the moon, and all this stuff, right? So it just brings in more interest. And a lot of you guys will probably know me as a trader. Those of you who joined the Discord, the Patreon, will know that I'm also a devoted long-term investor as well. But if you want to learn about trading, that's a different kettle of fish. We're going to leave that behind today, but I have videos about it, I teach about it, about portfolio risk management, entering, exiting, all the things you need to know to make trading profitable for yourself over time, plus a whole bunch of other technical analysis tools and Elliott Wave theory and all those kinds of things as well. But we're going to leave all of that aside today, and we're going to focus on investing over the long term. Okay, and the goal today for those people who are new to investing, new to this world of finance, maybe, or even this video might be useful to people who've been here for a while but just aren't getting anywhere. We're going to break down just how simple it is. It's easy peasy lemon squeezy. Okay, and the only reason that it appears that it's not is because we believe that this isn't. We believe that it's more difficult than it is. And the goal today of this video is to break down just how easy it actually is. Okay, and the most important thing to remember is that it gets easier over time. Right? You as an individual today, in the palm of your hand, can access the global markets. Right? Buy and sell anything at the speed of light. Okay, this is not true for your parents, this is not true for your grandparents. Okay, so we have access in a way that previous generations just haven't had. And that, in a way, makes everything so much easier for you. And it removes even more of the barriers, even more of the price of entry. You know, it takes all of that away and it makes things much more accessible. And we're going to talk about leveraging that to our benefit. Okay, so here we are on a chart of the S&P 500. Ticker SPX. This is the history of the S&P 500 index, top 500 companies in the United States, recorded on a graph since 1871 to today, 2025. So first things first, what do you notice about this chart? It goes up from bottom left to top right over time. So number one premise that we have to accept, if we're going to talk about long-term investing in the United States, and this is what we're talking about here, we're going to use the United States as our investment tool. So if we're talking about investing in the top 500 companies of the United States, we can accept that any period over the entire history of this chart, any long-term bet during your lifetime, sustained long-term bet on the future prosperity of the United States, would have been rewarded with higher returns, with profit, with gains. Okay, it goes up from bottom left to top right. So the next thing we have to overcome are those in the world who always tend to be louder than those of us who are positive, who have a positive outcome. We have to overcome those who've been infected by the fear virus. Okay, because the fear virus is omnipresent. It's nothing new. You know, if you were receiving a newspaper from a little young lad shouting extra, extra, read all about it back here in 1932 during the Great Depression, you would have been reading about how the market's never going to recover. It's never going to bounce back. All this money's been lost. We're in the worst depression ever. It's the end. Right? We're never coming back from this. You'd have been wrong to buy the fear. Maybe during the 1987 flash crash here, you know, stocks are done. All the abuses by brokers, the leverage, the the frothiness, the sheer over exuberance of the market has topped. That's it. We're done. We're on our way. New Great Depression. It's all going to unravel. That's it. What about the tech bubble? Okay, I mean, obviously in 1987 you wouldn't have been reading it in the newspaper. You could have. Maybe you heard about it on the evening news, on one of those little box TVs. Like maybe you got a nice TV at the time, but it's still been a box. You'd have to get up and change the channel, perhaps, rather than talking to your phone, which didn't yet exist to do it. Or maybe it's 2000, right? And the tech bubbles burst, and all the .com bubbles burst, right? And you're chatting on a very, very early internet chat room with a couple of people who also have internet dial-up access, 56k access, whatever, and you're talking about, wow, God, this .com crash is horrific, right? Oh, guys, it's terrible. It's the end of capitalism. Or maybe the global financial crisis. Now, a little bit more sophisticated internet usage at this point. We've got sophisticated phones, communications devices. We can share ideas over the internet much more freely. There's some social media developing here. Maybe you heard about it there. Right, this is the end of capitalism this time. This is it. We're done. Like, this is the biggest disaster ever. Lehman Brothers has gone bust. Bear Stearns has gone bust. This is it. This is the end of the West. We're done. Wrong again. Wrong again. Wrong again. Wrong again. Wrong again. What about COVID, right? COVID was a global pandemic. Oh my God, we shut down the global supply chains. Right, nothing's working. All these businesses are going bust. No one's making any money. Oh, Jesus Christ, this is really it this time. This is really it, guys. We are done. It's over. Yeah, wrong again. Okay, wrong again. Oh, and wrong again. And wrong again. And shall we move on to, what about April? Earlier this year, right? Oh, no. Liberation Day. Trump and his maniac tariffs that he's introduced, right? It's going to be inflation in 30 days' time. 20% inflation, global trade's going to collapse, these tariffs are going to ruin the economy, the stock market's topped. That's it, guys, that's it for stocks, man. There's too much risk, the market's topped, we're never going higher again, this is it, man, we're done, we're going to collapse, oh my God. Wrong again. Wrong again. So that's number 2. Ignore the media and news cycle. I've mentioned that we live in an age of nihilism, of doomerism, of obsessive negativity. People have replaced realism for cynicism, and they just see the world through that. And it doesn't matter whether you're arguing at each other's throats over Palestine and Israel, whether you're arguing at each other's throats over Trump, right? It's all theatre. And it's all fear. It's all polarising. It's all us versus them, left versus right. It's all hatred and negativity. And we're not talking about politics here. We're not talking about right or wrong here. We're not talking about morality. We're talking about making money over time. Believe me, and I'm not going to tell you how to live your life, but if you just focused on that a bit more and all the endless bullshit a bit less, your life would get easier. It would generally get easier over time. So that's number 1 and number 2, right? Number 1, accept what's on the chart. The United States is a country of 330 million people, and it accounts for roughly 1/4, 25% of the entire species global domestic product. Okay, this country of 330 million people, roughly, comprises 90% of all the global currency in circulation, and it happens to control that global reserve currency solely to itself. Right? This country also happens to have by far the most powerful military on the planet. This country also happens to control over 66% of all global debt is denominated in US dollars. Now, if we accept that information as fact, this chart as fact, the historical performance of it is fact, and we ignore all the bullshit, we might actually get somewhere. So those are the first 2 things we've got to accept. Now, every business is full of gobbledygook, but there's no business like finance for gobbledygook. We created language to convince you that you're stupid. Right? You need a fund manager to manage your money so he can earn his 2% or his 5%, because you're too fucking stupid to do it. Now the secret is you're not stupid. I guarantee you an awful lot of you are better educated than me and probably cleverer. Okay, but it doesn't take intelligence to make this work. Okay, but believe me, those with a vested interest to keep you dumb, to keep you fearful, to keep you fighting each other, keep you at each other's throats, they're doing it to make sure that you can never make money. They're doing it to make sure that you remain distracted, so they can make money. Okay, that doesn't have to be the way. We can take the power and the money from them and we can give it to you, not through some awful political scheme of wealth distribution which tramples everyone's freedoms. You can do it for yourself. You can take control of it yourself. Oh, so that's the first 2 points. Next point, number 3. I don't have time for that. I can't figure all that out. I haven't got time to manage this. No, mate, I can't be bothered. Right, an hour a month. Tops. Can you manage that? An hour a month, can you manage that? I think you can. Okay? So the onus is on you. And the onus is on you to accept this reality as we see it, to ignore the fear, and now to take responsibility. So what does that mean? It means no excuses. Okay? Oh, I can't afford to because I can't save any money, and every penny goes towards this. And it's like, okay, maybe for a small percentage of people in the Western world, that's true. But believe me, I know from experience that it's not. There are things which you are probably spending on which you don't need to be spending on. And there's the obvious things, the vices we engage in which damage our own health, which cost a fortune. Maybe they're a couple of them. Maybe it's the holiday you've just been on. Maybe it's the festival you've just gone to. Maybe it's a new pair of trainers you just brought. Whatever it is, right? No one's an angel. We all overindulge. We all spend on ourselves, and that's fine. Capitalism, consumerism needs us to do that. But if you can be the guy who doesn't leverage himself, indebt himself to the banks, doesn't run up credit cards, doesn't buy the latest greatest iPhone, doesn't buy the latest greatest this, that and the other, and is prudent and even frugal, right? And maybe says, you know what, I can squeeze 10% out of my budget. Actually, I can squeeze 15% out of my budget. Next step, there has to be some form of security, some form of liquidity that's available to you instantaneously in case of a disaster. Right? You got to have a cash fund. Yes, cash is depreciating, cash is being inflated away, but cash is how we operate on a day-to-day basis, and you're going to have to just bite the bullet on that one because emergencies come along. So you need some savings, right? What that is relative to your circumstances, your personal responsibilities. Okay, are you a single, groovy, no commitments, no ties young man, or are you a man who's just found out he's becoming a father, or has already got children, has got a house and a mortgage and everything else? Responsibilities are massively different. So that's for you to figure out what you need to pay several months' expenses. What cash would I need? Maybe it's a quarter, 3 months, maybe it's 6 months, but you need to have that set to one side, and that needs to be your first target. Once you've achieved that, you can come into this space and you can invest the rest. Everything after that can be thrown at the United States stock market. I'm not saying it's the only thing, but today we are, right? We're using the S&P as an example. Yes, you could buy Bitcoin. Yes, you could buy gold. Yes, you could buy XYZ assets. But we're just going to use the S&P 500 because we're talking about keeping it simple. So, after you've done that, then we can take the next step and start buying. And that's all we're going to do on a monthly basis. We're going to sign up to a broker which doesn't charge us commission. All right. Or we're going to take access to a financial asset. It could be an investment ISA where you get to pick what you put into it. You say, I just want an index fund. It could just be literally that, an index fund with an investment saving account. It could be just a brokerage account where you just buy a unleveraged ETF of the SPY, the SP, which is a proxy for the S&P 500. But either way, each month, that's what you're going to do. You're going to take that money after you've got your savings set and you've frugally budgeted, and you're just going to buy the United States S&P 500 index using the SPY ETF, SPY, which is accessible by any online broker. And you're going to do that each month, and it's going to take you probably less than an hour to allot that money. The next thing you need to accept is the market, although it's gone up from top left to top right, it didn't do this. It wasn't a straight line. Okay, wasn't a straight line. It was a wibbly wobbly line. Okay, which means you're going to be losing money. Not losing money as in it's lost and you closed out your position, right? You're going to have months, weeks, months, maybe even years during the global financial crisis period and a tech bubble where your money that's recently invested has depreciated in value. You do not sell. This is why we have cash available, right? As a first barrier, as a first moat around us, we have cash available that we've saved because that's for emergency, so that we don't ever have to sell anything we've invested in. This is a long-term strategy, long-term investment strategy. You're going to have periods where you're going to be underwater, but those periods we're about to see now are probably the periods of best opportunity for future financial returns, future stock market returns. So let's have a look at that. You're just going to invest. This is called dollar cost averaging. I know you've heard about it probably already, and those of you who are rolling your eyes going, oh yeah, timing the market beats timing the market, buy when others are fearful, sell when they're greedy, blah blah blah, right? It works, and it has worked in perpetuity. Okay, and all you've got to do is trade time for wealth, and that's it. If you are capable of it, you will be a beneficiary of it. Now let's move on and have a look at some of these indicators. We're going to come down to the weekly time frame because we don't need all the data going back to before the data was available. For example, we have a few indicators down here at the bottom. They all look extremely complex. They're not. They're extremely simple. So we have the University of Michigan consumer surveys. This is this purple line here, and on this I've drawn two little lines: extreme positivity, extreme negativity. This shows consumer sentiment over time. When the line is near this low, below the 50 bound, basically, we're talking about extreme negativity. Everyone thinks the world's going to end. All right, it's over. Trump's done something horrible, or JFK has just been shot, or a war in Vietnam, or whatever the hell it is, right? Everyone's negative. We're all going to be annihilated by nuclear conflagration, global financial crisis, so on and so forth. Then you got this thing. This is called the business cycle. This takes information from the Institute of Supply Management report on business for manufacturing. Information, believe it or not, that anybody in the world with an internet connection can access for free. Okay, you can go to the website itself, and this gives you a simple index to follow, right? Called the PMI. The PMI stands for Price Managers Index, and what that is all the data collected from the people who are responsible for purchases for manufacturing industry. So, and the way we explain it is we have a index with 50 as the median. This is the median line, and everything above the 50 bound is the business cycle expanding. So Main Street, if you think of it as Main Street, your infrastructure, your industries, your manufacturing industries, right? So everything from like car manufacturing to whatever, it's manufacturing. While the line is going up and away from 50, we are expanding. And while that number is increasing month on month, we are expanding faster. Everything above 50 is expansion. So whether you're going up or down, if you're above 50, it's all expansion. Going up consistently is expansion growing faster at a faster rate. Coming down above 50 is expansion slowing, but still expanding. So on the inverse, we've got contraction accelerating, all right, and contraction slowing. Contraction slowing is the point before the pivot into growth, okay, and growth slowing is the point of the pivot before contracting. All right, and this business cycle, because human beings are 100% cyclical. Right, there's an awful lot of people out there who would disagree with me. A lot of them are more progressively minded than perhaps I am, but they believe in something called change and progress. I know from observation that human beings are cyclical. Okay, we make the exact same mistakes generation to generation. We follow the exact same programming generation to generation. Nothing changes apart from the frequency and the amount of bullshit that people speak. That's the only thing that changes, and that doesn't change all that much either. It's just the more of it, the more easier it is to hear, the more media, so on and so forth. But generally, we grow, we shrink, we grow, we shrink, we grow, we shrink, we grow, we shrink, grow, shrink, grow, shrink, and that's all we do. Right, we borrow too much money. We grow our business. We borrow the money to grow our business. Rates are good. We borrow the money. We grow our business. Oh God, no, I've over leveraged. Business starts to slow down. Oh shit, interest rates have gone up. Oh bloody hell, I've got too much leverage to manage. Oh no, business contracts. All right. Oh, don't worry. Rates are low again. Funding's easy. Well, now I'll borrow and I'll grow. Oh no. Oh no. Same story. Oh dear. Oh, it's all right now. Economic conditions are improving. Oh no, done it again. And this is us forever. This is capitalism. And why does capitalism work so beautifully well? And you might disagree with that, but if you are, you're probably measuring it incorrectly, because it's not there to create a perfectly moral environment. It's not there to create utopia. It's there to function as capitalism is supposed to function, and it works bloody perfectly. All right. Why does it? Because it's literally human nature. Right. As soon as we could, as a species, figure out how to borrow from tomorrow to pay for today, as soon as we could, as a species, figure out how to give someone something of value so we can get the materials we need now, the second we figured out how to do it, we did it constantly and haven't stopped since. Because it's fucking awesome. All right. Because that's who we are. And we are cyclical creatures. Right, we're also pretty emotional, pretty silly at times. Now, on that note, let's now look at the next thing we're going to look at, which is our University of Michigan Sentiment Index. So you wouldn't believe how small this survey actually is. It's conducted by the University of Michigan. But the correlation between it and stock market returns is really quite phenomenal. But either way, extreme negative sentiment here, extreme positivity here. So what we're going to do is we're going to line up some of these lows. Let's do multiple lows, shall we? So we're going to look at how about we've got lows here on both. So this is the low of the University of Michigan Sentiment Index. This is the low of the business cycle. Where's the low of the stock market? Oh, there it is. Right, so what about this one here? 1980. So we've got a low in consumer sentiment. We've got a low in the business cycle. We've got a low in the RSI on the weekly time frame. And, we've got a little low here, but it's still a low. Right, what about move over a bit then? We've got a low here. We're in contraction. We're in pretty negative territory. There's a low in the business, there's a low in the stock market, and we could carry on doing this. Here's the lows, a little bit off. They don't line up perfectly. They're not always going to line up perfectly. Here's some lows in the stock market. What about some big ones then? Some really big ones. So let's take a look at end of world events. So low in the business cycle, low in consumer sentiment, low in the MACD, low in the RSI. Bullish divergence in the RSI actually, which is a really excellent reversal signal for the low. If you don't know what that is, don't worry about it. It's a trading terminology, but there was a signal here that you should have been buying into this low. From a trading point of view, there's a low in the stock market, low in the MACD, low in the RSI, low in the University of Michigan Consumer Survey Index, and low in the PMI. Okay, so we can move on. Let's take a look in what was this COVID over here. Let's have a look at COVID. So we're taking lows of COVID. If we can just put a goddamn line on the chart, we will. Oops, move it over here. Low in the business cycle, low in consumer sentiment, low in the MACD, low in the RSI. Shall we take, what about the most recent then? Trump and his tariffs, right? That's been the narrative, right? Did you buy it? Did you buy the bullshit? Did you buy the fear? Okay, did you believe that crap? Low in the stock market, low in the RSI, low in the MACD, low in the University of Michigan Survey Consumer Index, low in the business cycle. In fact, the business cycle has been suppressed for one of those longer periods. It goes through this, went through here in the early 2000s, went through this before in the 1950s and 80s. So we have periods of sustained lows. But you take my point. We're talking about opportunities, right? When the market sells off, yeah, you can carry on. You could carry on dollar cost averaging, and over the long term, it would have paid off, right? You would have continued to make. You would accidentally buy the lows occasionally, is what I'm saying, by averaging in every month. You would buy the lows and you'd smooth the whole process out over a decade or 2 decades. But if you actually listen to these indicators, where consumer sentiment's rock bottom, when the media is spreading the highest amount of fear, when the business cycle looks like manufacturing's never coming back, right? If you actually double down at those points with the spare cash that you've got, maybe buy twice that month rather than once, you do even better. You do even better. So now we've talked about a few indicators. Talked about the business cycle, talked about consumer surveys, right? We talked about how the market goes up from left to the right. We talked about investing over the longer term. Let's talk about the secret sauce on top of all of this, right? Because if it's not the media cycle that drives markets, and maybe it's not the business cycle, which always does, and maybe it's not even consumer sentiment, I'll tell you one thing which does. This is global M2 money supply placed over the stock market. From the end of the global financial crisis, roughly 2009, because we don't have data for M2 from the Fed before that time. Okay. What do you notice? What do you notice? They're basically in lockstep with one another. There are periods of divergence. Normally the market hangs on and strives for higher highs even though liquidity is dropping off. That's what we mean by there's more cash. That's a special word, gobbledygook word, liquidity. There's more cash available. Right? But that's what it means. So, for example, here's a little period of divergence. Market continues higher. Global liquidity, M2 money supply was coming down. Global M2 was coming down. Right? Market can hang on and remain irrational longer than you can remain solvent. That's an old saying. But generally, they're in lockstep with one another. Up and bottom left to top right, bottom left to top right. The United States, as I already mentioned, is the hold of the global reserve currency. And the dollar has lost 99.9% of its value over its lifetime. People go, oh, the dollar's rubbish then. The dollar's held more value relatively to pretty much every other fiat currency in the world by a significant margin, even though it itself has depreciated by 99.9%. Sounds like a contradiction, but it's not. In other words, they've all lost 99.9% of their value, but some have lost 99.98, some have lost 99.999998. Alright, you see what I'm saying? All fiat's garbage, and we run the world on debt. We run the world on debt. Okay, and we run the world and the stock market and asset prices in general, not just the stock market. This correlates with gold. This correlates with real estate. This correlates with Bitcoin. Okay, if we print more money, financial assets go up in price. And we have backstopped the market continually since the last great problem we had, which was the global financial crisis. We faced potentially more calamitous circumstances since, such as a global pandemic, right? And we didn't hesitate in how we responded. The global financial markets are backstopped, right? We are not going to let them fall, right? They will correct for a little while, and then the money printer go brrr, as was a meme during COVID. The irony is, a lot of the kids which got in during COVID, right? Because I'd been here for years by the time those kids showed up. They got the idea right. They got the sentiment right. Okay, money printer go brrr, stocks only go up. And yet they all got wrecked. Why? Because their fucking time frame was off. Right? They were all trying to achieve one thing. Get rich quick. If there's one scam in the world which has worked today, yesterday, a century ago, a millennia ago, it's a scam of get rich quick. Right? You can only get rich slow. Anything else now doesn't mean that people haven't. Anything else is called luck. Right? If you are lucky enough to win the lottery and your government is a government in a country which doesn't take 50% of your proceeds, that's probably the biggest single win you can get in one go. Right? Anything else requires obscene amounts of risk. And I mean obscene amounts of risk. Right? The lottery ticket doesn't. You buy it, you win millions, right? Okay, I'm not encouraging gambling on the lottery, by the way. I'm just pointing out that that's a circumstance of life-changing money which can come overnight without the insane risk. You've only got to go and visit a thread on the Reddit called Wall Street Bets to realise the kind of degenerate, insane risk-taking which is always omnipresent in human society, but is multiplied during periods like we had during COVID, where we're all sat at home with no job to do and government's handing out free money. Okay, so Tom's ranting and raving is finally over for the day, so we're going to summarise now in a few simple points. We're going to talk about each of these points. So, number one, accept that the chart goes from bottom left to top right. The chart has gone from bottom left to top right all of your lifetime, all of your mummy and daddy's lifetime, all of their mummies and daddy's lifetime, and before that. Okay, so to stand in the face of it and assume that it's going to now suddenly go to zero, you are telling the entire world that you know something nobody else does. The chances are, being new to investing, or even if you're a veteran of investing, the chances of that statement being correct is extremely unlikely. So let's accept that the chart goes from bottom left to top right. If we're going to invest in the United States long term, we need to believe that. Number two, ignore any information to the contrary. Fear virus, media. Okay, we will get talked out of our long-term strategy if we give in to fear. If we give in to media, if we give in to the nihilism and the negativity which is constantly being rammed down our throats. If we can just turn the damn media off, turn the news off, and just stay focused on our long-term dollar cost averaging goal in the United States stock market, we will be successful over time. Odds on you will be successful over time. Now, please don't misinterpret this. The traders out there who are listening to me, those of us who make a living off of the volatility in these markets, myself included, over multiple time frames, some very short day traders all the way up to swing traders over the monthly time frame, we do need to pay attention to rates changes. We need to pay attention to the ISM. We need to pay attention to consumer sentiment. We need to pay attention to liquidity, momentum. All of these things we need to pay attention to. Okay, but that's not who I'm talking to today. I'm talking to the person who wants to make this simple, who wants to deal with this for 1 hour every month. And you do need to not waste your time thinking about all of that finance jargon. You do need to ignore the media and the fear virus, and you do need to just dollar cost average every month into this thing. That's what you want to focus on. Number three, budget accordingly, taking care of savings first. Now, we've spoken about finding those savings. That's going to be individual to each person. If you can't, and you can't do this anyway, there's no point wasting your time watching this video or arguing with me, right? But if you know that you can, and you know that you could find more, and you want to do this, then you're obligated to do it. But you must take advantage of the opportunity, and you must take precautions first. You need cash savings first. You need to be able to say, before I invest, before I take any risk, before I deal with any of this, I could live off of this reserve for the next few months while I find other work, while I find a side hustle, while I find a solution, right? You've got to have that cash, you've got to be liquid. After you've done that, you can throw your money in monthly at the market. Number four, dollar cost average over time and increase allocation during times of fear and negativity. When the market reaches its lows, it's because the last person who's going to sell has sold. That's the bottom. That can only happen if the environment is one of absolute fear and negativity. People are not going to be euphorically bullish and buying under those conditions, are they? They're going to be selling. And it's only when the fear has reached its maximum point, it's only once the negativity has reached its peak that the last person who's going to quit has quit. That's when you double down. And these opportunities come along systematically. We've already looked at the chart, we've seen them, we've named them, we've talked about more recent examples and older examples. They come along systematically. Human beings are cyclical, so they come along cyclically, I should probably say. And they will continue to do so in perpetuity. Wait for them to come along, don't be afraid, go back to step two, ignore the fear virus, and take advantage of the opportunity. If you've got the spare cash available this month, or you know the market started selling off, maybe start budgeting even more, to add even more next time you dollar cost average in. And remember, the goal of all of this approach is to get rich slow, because for time immemorial, get rich quick is the oldest scam in the book, and anyone trying to sell it to you is lying, because bar winning the lottery and risk free, bar a couple of dollars, couple of quid, bar winning the lottery on the cheap, the risks you have to take to get rich fast, for the average investor, for the average Joe public, even for most veteran traders, it is simply not worth it. So get rich slow. Alright then guys, thank you very much for joining me on this YouTube video. I hope it's been informative. If you're new to this world, I hope it's informative. If you've been in this world for a long time and maybe it's time to make a change about your approach, I hope it's been informative and helpful as well. That's all I intend to do at the end of the day. But if you do want to learn about trading, and if you want to learn about technical analysis, you want to learn about Elliott Wave and a whole bunch of other things like that, there's a link to my Patreon in the description box below. Feel free to go sign up. It's only 10 quid a month. You can leave it any time. If you want to go to the higher tier, tier 3, it's 15 quid a month. You can leave it any time. You can get access to a whole bunch of fascinating educational videos, plus additional content, plus a public Discord, a whole bunch of other benefits. And maybe you'll open up a whole new world to yourself. But if none of that appeals to you and all you want to do is just buy the S&P every month, it's a bloody good strategy and it's paid off for everyone who's done it over the last 100+ years. So rock on. Take care guys, I'll be back with you as soon as I can. All the best. Bye bye.